The recent release of the ISM Services report, indicating a notable increase in inflationary pressures, prompted traders to adjust their expectations regarding potential Federal Reserve interest rate cuts. Consequently, this led to a strengthening of the US dollar. Despite this, Federal Reserve members maintained a hawkish stance, emphasizing their reluctance to implement any policy loosening measures. Nevertheless, amidst these developments, Wall Street achieved record highs, with the S&P 500 index reaching the historic milestone of 5,000 for the first time ever. This bullish sentiment was further reinforced by the Bank of Canada governor's remarks aligning with other central banks in resisting immediate rate cuts. The governor highlighted concerns over persistent inflation and clarified that the Bank of Canada is not currently considering a timetable for such cuts. Meanwhile, the Reserve Bank of Australia opted to keep its cash rate unchanged at 4.35% for the third consecutive meeting. However, the bank maintained a bias towards tightening in its statement, expressing unease over persistently high inflation levels. In the realm of geopolitics, crude oil prices experienced a sharp increase of over 3.4% following Israel's rejection of a ceasefire proposal in Gaza. This decision heightened concerns of a potential escalation in Middle East tensions, thereby impacting global oil markets. Despite the optimism surrounding the S&P 500 reaching the 5,000 milestone, there remains speculation about traders' willingness to further drive the index upwards ahead of the weekend. Some may opt to capitalize on recent gains, potentially triggering a temporary pullback in the market. On a different note, China's consumer prices recently experienced their most significant annual decline in 14 years, registering at -0.8%. While this suggests sluggish economic growth in China, it also highlights the deflationary pressures that could potentially spill over to Western economies. USA. The United States releases two significant inflation reports each month, the Consumer Price Index (CPI) and the Personal Consumption Expenditure (PCE). While the Federal Reserve typically favors the PCE report due to its lower volatility, traders closely scrutinize CPI figures, especially with the upcoming release scheduled for next week. Inflation expectations play a crucial role in shaping CPI figures, with one measure from the New York Fed set to be released on Monday. Initial analysis of the New York Fed's 1- and 3-year CPI expectations, alongside the Michigan 1-year inflation expectations and CPI year-on-year itself, indicates a downward trend. This has led to speculation that the Fed might consider rate cuts. However, it's important to note that none of these metrics are currently close to the Fed's 2% inflation target. Failure to reach this target within the next year could potentially impact consumer behavior and further delay achieving the desired inflation level. Any unexpected increase in CPI expectations ahead of the CPI report could bolster the US dollar and dampen expectations of rate cuts in the first half of the year. Conversely, a decline in CPI expectations could lead to a retreat in the US dollar's value before the CPI report and a sharper decline if actual inflation figures fall below expectations. US economic data has fallen short of expectations since the beginning of the year, especially considering that traders had initially priced in up to 175 basis points of rate cuts. Although expectations have been revised downward, with markets now only anticipating 125 basis points, some believe even this may be overly optimistic, particularly in light of the disappointing January jobs report. Friday's revisions to U.S. inflation figures alleviated concerns, but attention is now focused on various January data releases scheduled for next week. CPI inflation remains a focal point as analysts seek indications that short-term inflationary pressures have diminished, potentially increasing the likelihood of a rate cut in May. However, alongside CPI, traders will closely monitor other releases such as retail sales, jobless claims, and consumer sentiment. While inflation is a key consideration, a comprehensive analysis of these combined factors provides a nuanced understanding for the central bank. Ultimately, the Fed remains committed to implementing rate cuts only when convinced that inflation will sustainably return to the target level. Inflation in the United States has been trending lower, but progress towards reaching the 2% target has stalled in recent months, particularly according to the CPI metric. While Fed officials express optimism that price measures will continue to decrease over the next few months, the resilience of the U.S. economy poses a challenge, as robust domestic demand increases the likelihood of inflationary pressures resurfacing, especially in the event of significant wage growth acceleration. The Consumer Price Index rose to 3.4% year-on-year in December, maintaining levels above 3.0% since last July. However, there was slightly better news for core CPI, which eased below 4.0% year-on-year for the first time since May 2021. The outlook for PCE inflation, the Fed's preferred measure, is somewhat more encouraging, particularly on an annualized basis. Headline PCE stood at 2.0%, and core PCE at 1.9% on a 6-month annualized basis in the last 2 months of 2023. This may have contributed to the market's anticipation of an imminent dovish pivot by the Fed. However, Fed officials have overwhelmingly signaled that a rate cut may be some time away, bolstering the US dollar as investors priced out a potential move in March. Tuesday's CPI print could be pivotal in determining whether easing expectations will be further delayed, as investors still perceive a strong likelihood of a rate cut in May. Forecasts suggest CPI will remain unchanged at 3.4% year-on-year in January. Concerns extend beyond the pace of inflation decline. The U.S. economy appears to have experienced an uptick in activity in January, making Thursday's retail sales numbers crucial. The consensus estimate points to a 0.2% month-on-month increase, indicating a cooldown from December. In addition, other data releases scheduled for Thursday include the Philly Fed Manufacturing Index and industrial production figures for January. Wrapping up the week on Friday are housing starts, building permits, producer prices, and the University of Michigan's preliminary consumer sentiment survey. Eurozone. The Eurozone managed to skirt a recession at the end of last year, but concerns linger that it might have only postponed the inevitable. GDP data for the fourth quarter, set to be released on Wednesday, is anticipated to reveal that the bloc failed to register growth once again in the final months of the year. Even a minor deviation from expectations could leave the euro area vulnerable to slipping into recession in the current quarter. However, ECB policymakers are unlikely to be significantly swayed by whether the eurozone narrowly avoids a technical recession. The more pressing issue is the concurrent decline in inflation, which is expected to continue its descent in the coming months. This juxtaposition of stagnant growth and falling inflation levels may prompt closer scrutiny from policymakers. We can anticipate insights on this matter from several ECB officials in the upcoming week. UK. Inflation in the UK experienced a rapid decline towards the end of 2023 before showing a slight uptick. If both headline and core consumer price index (CPI) resume their downward trajectory in January, it would likely be a welcome development for the Bank of England, albeit potentially unsettling for the pound. However, forecasts suggest that only the core measure is expected to decrease, while headline CPI is anticipated to climb again to 4.2% year-on-year. Despite policymakers pushing back on market expectations of an imminent rate cut, investors could intensify their bets in the event of an unexpected drop in inflation. However, similar to the situation in the US, the economic performance in the UK is not solely determined by inflation dynamics. Recent indicators suggest that the economy has been performing better than anticipated. While there were concerns about a recession after UK GDP contracted by 0.1% in the 3 months to September, Q4 data expected on Thursday is forecasted to show that the UK economy avoided a recession and recorded flat growth during the period. Furthermore, attention will be on retail sales numbers on Friday to gauge signs of recovery in consumer spending, particularly following an upbeat Services Purchasing Managers Index (PMI). Additionally, the labor market will be under scrutiny, with the employment report for December due on Tuesday. Any unexpected strength in the jobs market could dampen expectations of a rate cut and potentially boost the pound. While the Bank of England may not be ready to implement interest rate cuts yet, next week's data releases will offer insights into their stance. The highlight will undoubtedly be the CPI data on Wednesday, given the BOE's mandate to maintain inflation at 2%, which was double the level it stood at in December. Expectations of declining inflation in the coming months are prevalent, but a sharper decline in January could bolster the case for rate cuts sooner. Conversely, a higher inflation figure could pose a significant setback, suggesting a stall in progress and potentially leading to a scaling back of rate expectations. The jobs report on Monday, particularly the average earnings component, will also be closely monitored, as it is a major contributor to price pressures. With average earnings growth, including and excluding bonuses, exceeding 6% in the 3 months to December, a level far above what is consistent with 2% inflation, it raises concerns about achieving sustainable inflation in the services sector, an area of focus for central banks. Canada. January marked a significant milestone in Canada as unemployment fell for the first time in over a year, typically a positive development in normal circumstances. However, this comes at a challenging juncture for the Bank of Canada, which is striving to introduce some slack in the labor market to meet its inflation target. This unexpected decline in unemployment is far from ideal, especially as the central bank contemplates a potential rate cut in the summer. Nevertheless, the path to monetary policy decisions will depend on further improvements in the data leading up to that time. Looking ahead, next week's economic calendar for Canada appears relatively quiet, with only Tier 3 data releases scheduled. Australia AMD New Zealand. The Australian dollar has faced challenges since the beginning of 2024, despite expectations that the Reserve Bank of Australia (RBA) will be among the last central banks to implement rate cuts this year. The resurgence of the US dollar and concerns over China's economic situation have outweighed the RBA's relatively more hawkish stance. However, a potential bright spot for the Australian dollar could come from improvements in the labor market. December saw a surprise decline in employment, but Thursday's upcoming jobs numbers are anticipated to provide some relief, with expectations that the Australian economy added 30,000 jobs in January. This could lead to a rebound for the Australian dollar from its multi-month lows against the greenback, as investors recalibrate their expectations regarding the frequency of RBA rate cuts this year. With Chinese markets closed for the Lunar New Year celebrations for the entire week, the Australian dollar may be more sensitive than usual to domestic data releases. Meanwhile, across the Tasman Sea, the New Zealand dollar will be closely monitoring the latest inflation expectations survey on Tuesday, which the Reserve Bank of New Zealand publishes quarterly. In the previous report, one-year inflation expectations had declined to 3.6%, and two-year expectations to 2.8%. Should expectations for future inflation continue to trend downwards, this could dampen any hawkish sentiment from RBNZ Governor Adrian Orr when he speaks on Thursday. However, any negative reaction in the New Zealand dollar is likely to be short-lived, as the RBNZ would require further evidence of easing inflation before adopting a more dovish stance. Japan. In Japan, all eyes will be on the nation's fourth-quarter GDP readings scheduled for release on Thursday. After experiencing a sharper-than-anticipated contraction in the third quarter of last year, economists project a rebound of 0.3% quarter-on-quarter in the final 3 months of 2023. Should Thursday's figures fall short of expectations, doubts regarding the strength of the recovery are likely to persist, especially considering recent mixed data amid subdued consumption. However, the boost from higher exports likely contributed to GDP growth in Q4. The Bank of Japan is pinning hopes on this year's shunto wage negotiations to stimulate wage growth and foster more sustainable inflation. Achieving this target may prove challenging, even if the BOJ expresses confidence in projecting it. Therefore, a robust economic backdrop is crucial for lending credibility to its forecasts. The yen could face downward pressure in response to a softer-than-expected rebound. However, an upside surprise cannot be discounted, particularly given the positive sentiment expressed by most businesses in the BOJ's recent Tenkan surveys.